Usually, when a city upgrades its infrastructure, there's this expectation of, highly visible, massive construction.
Oh, yeah. Cranes everywhere.
Right. You see the massive cranes, you navigate around the closed down roads, and, well, everyone driving by knows exactly what's happening. A new bridge is being built. It's clean, it's obvious, and it's really loud.
It is entirely out in the open for everyone to categorize. You understand the inconvenience, I mean, because you can actually see the concrete being poured.
Exactly. But then you look at the financial plumbing of a major tech company, and suddenly that construction is completely invisible.
Hmm.
You don't see the cranes, but the entire foundation is shifting underneath your feet.
Yeah, they're actively ripping out their foundational pipes while the water is still running.
And from the outside, the house looks exactly the same. It's wild.
Okay.
Anyway, it is Thursday, May 14th, 2026, and our mission today for this deep dive is to decode how an AI lending pioneer, Upstart, is trying to completely rewrite its own financial plumbing.
Which is no small feat.
Definitely not. We are exploring how they are expanding their product ecosystem and navigating some truly massive operational growth. And we are doing this by looking at the raw, unfiltered Q&A segment from Upstart's Q1 2026 earnings call.
Which really is, honestly, the only place to look if you want the truth of a company's trajectory.
Right, because the prepared remarks are...
Yeah, they're always perfectly polished, legally vetted PR scripts. But the Q&A segment, that is where Wall Street analysts push for real answers and leadership has to respond on their feet without a teleprompter.
It's where the actual strategy, the underlying tensions, and, sometimes the missteps are laid completely bare. Okay, let's unpack this, starting with the most fundamental shift in Upstart's entire structure.
The bank charter.
Yes. They are applying to the OCC, that's the Office of the Controller of the Currency, for a national bank charter. Now, on the surface, getting a bank charter sounds like they want to become a traditional brick-and-mortar style bank, holding consumer deposits and managing checking accounts.
Right, which would be a massive pivot.
Exactly. So is getting this charter basically like getting a VIP pass to skip the regulatory line rather than trying to buy the whole nightclub?
What's fascinating here is that your VIP pass analogy captures the exact mechanism of their strategy. Upstart leadership was incredibly explicit during the Q&A about what this charter actually means for them.
So it's not about becoming a traditional bank.
No, not at all. This is strictly about the regulatory benefits. It is emphatically not a balance sheet strategy.
Okay, so they aren't trying to change how they actually fund the loans themselves. They don't want, your savings account.
Exactly. Let's look at how this usually plays out. Typically, when a fintech company applies for a national bank charter, their ultimate goal is to start taking in cheap consumer deposits.
Right, to fund their lending operations.
Yeah, they want to fundamentally change the amount of capital they need to run the business by leveraging customer cash. But Upstart is looking at the market and saying, no, we are perfectly fine with our current funding model.
Which relies on third-party institutional investors and credit unions, right?
Yep, exactly. They simply want the operational and financial improvements that come inherently with the unified regulatory framework of being a national bank.
So where are they in the process right now?
Well, they're currently working with the OCC, and, while they wouldn't commit to a concrete timeline on the call, because you obviously don't rush federal regulators.
No, definitely not a good idea.
But they noted that the regulators have been highly engaged and, quote, very constructive.
I mean, I have to push back on that, though. Applying for a national bank charter is a massive, highly scrutinized, multi-year headache.
Oh, absolutely.
It opens your books to a level of federal oversight that most tech companies try to avoid at all costs.
Yeah.
So why go through the grueling pain of dealing with federal regulators if you aren't even going to use the charter to hold cheap deposits?
Yeah.
What is the actual tangible incentive here that justifies the headache?
The incentive is patching a massive bleeding hole in their current operational structure. During the call, management actually quantified this leak. They cited $200 million in annual friction costs.
Wait, $200 million? I'm looking at this sort of material. And an analyst specifically points out that Upstart's revenue guidance for the period was around $294 million.
Yeah, it's a staggering comparison.
Are they seriously claiming they are just bleeding $200 million in operational inefficiency? That isn't couch change. That's like nearly doubling their revenue if they capture it. How does a tech company lose that much in friction?
Well, it requires us to completely redefine how we think about the word friction. When we hear costs, we usually visualize line items on an expense report, right?
Yes, server costs, payroll, real estate, that kind of thing.
Exactly. But Management broke this 200 million down into three very distinct structural buckets. And the first bucket isn't a direct expense at all. It is missed revenue due to regulatory fragmentation.
Meaning they are locked out of markets simply because of red tape.
Yes. Let's break down the mechanics of that red tape. Because Upstart currently operates without a national charter, they do not have a unified set of federal rules.
Oh, so they're dealing with state laws.
Right. They have to navigate a labyrinth of 50 different sets of state-by-state lending regulations. This means there are numerous states and specific credit segments where they simply cannot operate legally.
Or their operations are just severely restricted by local interest rate caps, I imagine.
Exactly. The local caps are so tight that the AI models can't deploy effectively. So a national bank charter acts like a master key. It preempts a lot of that state-level fragmentation and unlocks the entire addressable market across the country.
Okay, so it gives them a standard rule book.
Yes. Specifically, it allows them to operate uniformly up to a 36% interest rate cap nationwide. So a huge chunk of that 200 million is just the total addressable market, the TAM, that is sitting right there, but they are currently locked behind state borders.
Wow. Yeah, if you can't legally deploy your product in a state, your AI's predictive power is completely useless there.
100%.
You are leaving money on the table simply because the legal framework in Ohio is different from the framework in Texas. So if bucket one is the revenue they are locked out of, what is creating the actual drag on the revenue they are already generating?
That brings us to the second bucket, which covers the direct, hard costs of their current setup. Right now, to navigate all those complex local rules, Upstart doesn't just issue a loan directly.
Right, they use partners.
Yeah, they have to originate loans through a large network of intermediary financial institutions, often called sponsor banks.
And I imagine passing data through a traditional bank's legacy infrastructure isn't exactly a seamless, free process.
Oh, it is incredibly inefficient. Just think about the mechanics. Upstart is this highly advanced AI brain, but they have to use a traditional bank's arms and legs to actually issue the capital.
That sounds clunky.
It is. Every single time a loan gets processed, data has to be passed back and forth between Upstart's cloud and the sponsor bank's legacy servers. The sponsor bank has to run its own redundant compliance checks.
They probably have to hold the loan briefly before it moves on too, right?
Yeah. All of that takes time, and more importantly, those middleman banks take a cut of the economics. Managing that massive, complex network of third-party players creates incredible operational drag and direct financial costs.
So the charter lets Upstart cut out the middleman entirely and become its own arms and legs.
Exactly.
Okay, so we have the missed revenue from locked state markets, and we have the direct financial toll of paying sponsor banks to act as regulatory shields. What is the third bucket? Because a $200 million figure usually relies on something a bit more, forward-looking to justify the massive undertaking of a bank charter.
It does, and this third bucket might actually be the most crucial one for their long-term survival, even though management admitted on the call that it isn't strictly quantified in that $200 million figure.
Oh, what is it?
It is the intangible AI factor.
The intangible AI factor.
Yeah.
Why does a company need a federal bank charter to improve its artificial intelligence? That feels disconnected.
Well, it isn't about improving the algorithm itself. It's about explaining the algorithm to the people who hold the keys to the industry.
The regulators.
Right. Upstart's entire core thesis is that the next 10 years of consumer credit will be completely defined by artificial intelligence. Federal regulators know this wave is coming, and they are desperately trying to understand how to regulate machine learning in finance.
And right now, Upstart is forced to use a middleman for that conversation.
Yes. Because they use sponsor banks, they have to communicate with federal regulators through those intermediaries. It's like playing a high-stakes game of telephone regarding the most complex technology in the world.
So Upstart explains their AI to a regional bank executive who then tries to explain it to an OCC regulator.
Yeah, you can see the problem.
That sounds like a recipe for massive misunderstandings.
It is a huge strategic vulnerability. Upstart wants a direct relationship with the regulators. As one of the pioneers in applying AI to lending, they want to be the ones sitting in the room directly educating the regulators on how this technology actually prices risk.
They want to help set the frontier of AI regulation, basically.
Precisely.
Right.
Rather than passing notes through a middleman who barely understands the code themselves.
That makes perfect sense. I mean, it makes you think about how often in business, or even just in your own career, for you listening, we build these incredibly complex, patched-together systems that just end up bleeding efficiency over time.
Oh, cons?
Sometimes you can't just keep patching the pipes. You have to tear out the foundation
Mhm.
and rebuild it if you actually want to scale. Upstart is tearing out the middleman to go direct to the market and direct to the government.
Which brings us to a really interesting tension in the Q&A regarding how they manage the cash they currently hold.
Right.
If they are so hyper-focused on saving this $200 million and becoming radically more efficient, we have to look at how they are allocating their capital today.
Let's follow the money, which leads us directly into their share repurchase strategy.
Hmm.
On the call, an analyst points out that Upstart bought back $100 million in stock in the first quarter alone. And they still have just over $100 million left in authorized buybacks. So I have to ask, if you have the board's authorization and you have the cash sitting on the balance sheet, why wouldn't management aggressively buy back stock to boost the share price, especially if they believe the company is undervalued?
Because they view equity as having a very real, tangible cost. They see capital allocation as a strict math problem. They do not just buy back stock simply because they have cash sitting around burning a hole in their pocket.
So they're cautious.
Very. Management views buybacks through the lens of maximizing long-term returns while minimizing shareholder dilution. It depends on their available cash, their liquidity needs for funding loans, their macroeconomic forecasts, and of course, whether the stock is trading at what their models consider the right price.
Okay, that makes sense.
But the critical concept they introduced in this response is their internal hurdle rate.
Hurdle rate, like the literal bar an investment has to jump over to justify spending the cash.
Precisely. Every single dollar on Upstart's balance sheet is in an internal competition for survival. The main reason they're not constantly in the market buying back their own stock is that their internal hurdle rate is incredibly high.
Because they have other things to spend it on.
Exactly. They believe they have so many massive growth opportunities right in front of them, investing in the AI models, building out new loan categories, funding operational transitions, that using their cash for anything else requires a massive mathematical justification.
Even buying their own stock.
Yeah. The business itself is just too hungry for capital to fuel its own growth.
Okay, well, if their internal hurdle rate is so high because they are funneling all this cash into product expansion and AI development, we need to look at whether those investments are actually paying off on the bottom line.
And this is where it gets a little tricky.
Yeah, because looking at the Q1 numbers, there is a major contradiction that genuinely confused me. Volume grew by a staggering 61% year over year. Overall revenue grew by 44%.
Those are monster numbers.
Huge. But then the take rate, which is the percentage fee Upstart, actually extracts from the loans they process dropped. In any other industry, if your volume is skyrocketing but your margins are shrinking, it triggers an absolute investor panic.
Usually, yes.
It typically means you are slashing prices just to buy growth. Why wasn't Wall Street freaking out about a dropping take rate?
Because context is everything. What's fascinating here is how management reframed that metric. The take rate for Upstart is an output metric, not a managed input metric.
Wait, explain that.
Well, they're not sitting at a dashboard pulling a lever to force the take rate up or down.
Here's where it gets really interesting. So the take rate is basically a speedometer rather than the gas pedal.
I like that, yeah.
It just reflects what the engine is doing. It isn't driving the car. But that still doesn't explain why the speedometer is dropping while the car is speeding up.
It dropped entirely because of a mix shift in the types of loans they're processing. Upstart is expanding rapidly into prime personal loans, which are loans to highly qualified borrowers. And they are seeing huge growth in secured products.
Meaning auto loans and home equity lines of credit, or ELOCs, right?
Exactly.
Let's use an analogy here. It feels like an airline that historically only sold highly profitable, very expensive first-class tickets. Suddenly, they decide to buy a fleet of massive planes and fill the back with economy seats.
That's a great way to put it.
Right. The average profit per seat drops dramatically because economy tickets are cheaper, but the total revenue of the airline skyrockets because they're flying thousands of more people.
That is a brilliant way to conceptualize it. Let's take that a step further and look at the mechanics of risk. When Upstart shifts into secured loans like auto or home equity, there is physical collateral backing the loan, a car or a house.
So the risk goes way down.
Exactly. Because there is collateral, the inherent risk of the loan goes way down. But because the risk is lower, it is a highly competitive market among banks. To win that highly qualified customer, the upfront fee you can charge simply has to be lower.
Ah, so when you start blending thousands of these lower-margin, highly secure loans with their traditional higher-margin, unsecured personal loans, the blended average of your take rate is naturally going to shift downward.
Spot on. Management stated this drop was entirely expected, mathematically sound, and built into all their forward-looking models.
Okay, so they haven't lost an ounce of pricing power. They're just selling a different mix of products at massive scale.
Right.
But when the analysts pushed them on where future margin growth is actually going to come from, how did they respond?
They pointed to two distinct levers. First, ongoing improvements in unit economics, meaning getting cheaper and more efficient through automation.
Like the AI doing more of the heavy lifting.
Yes. Every time the AI gets slightly better at instantly verifying income without human intervention, the cost per loan drops. Second, they plan on selling a higher percentage of loans currently sitting on their balance sheet to third-party investors.
Did they give any specific numbers for that?
For those new secured products, auto and home, management gave a midterm expectation of roughly a 4% upfront fee and a 2% servicing fee over the life of the loan.
Which naturally brings up one of the most revealing, unscripted moments from the entire Q&A.
Oh.
An analyst was digging into those servicing revenues, and they noted that there was a sudden $3.9 million jump in a category called Other Fees.
Yes, a category that had historically been sitting at basically zero.
Right. And management actually had to pause the call, confer, and admit, quote, "We're going to have to follow up with you on that specific number."
You rarely see that level of vulnerability on a public call, but it highlights exactly why we study the Q&A.
Because it's messy.
It is messy reality. When you are managing a massive portfolio transition, bringing entirely new asset classes online, and shifting billions of dollars around, even the executive team doesn't have every single $3.9 million localized variance memorized.
Yeah, that makes sense. Moving past that specific line item, the broader discussion about these product margins brought up a philosophical point that, honestly, completely changes how we should evaluate tech companies.
Oh, this was a great part of the call.
One of the analysts asked a seemingly straightforward question. How long does it take for a new product, like an auto loan, to reach a mature unit economic profile? Do you need 12 months? 24 months?
And management's response to that question is arguably the most important insight to extract from this entire deep dive. They explicitly stated there is no single moment a product is considered mature.
Which flies in the face of everything you learn in traditional business strategy, where products have a very clear, predictable life cycle. Introduction, growth, maturity, and eventually decline.
Traditional businesses have mature products. Upstart is an AI company. They pointed out that their core personal loan product, the thing they've been doing for years, took 7 to 8 years to reach the margin levels it enjoys today.
7 to 8 years.
Yes, and it is still improving. Why? Because the AI models are continuously ingesting new data. The automation gets sharper year after year, and as the AI gets better at predicting risk, it creates wider and wider distance from what they call the next best offer.
Okay, let's dive into the mechanics of that.
Oh.
In the competitive lending space, what exactly is the next best offer, and how does Upstart's specific AI manipulate that to their advantage?
Let's say you apply for a personal loan. A traditional bank evaluates you using a legacy FICO score, which is a very blunt, outdated instrument.
Right, it doesn't tell the whole story.
Exactly. The bank looks at your FICO score, bakes in a ton of assumed risk because they don't really understand your full financial picture, and offers you a mediocre interest rate. That is the next best offer. Upstart's AI, on the other hand, looks at thousands of data points, your employment history, your cash flow, macroeconomic trends, and assesses your true underlying risk with surgical precision.
Because Upstart knows you are actually a safer bet than the FICO score implies, they can offer you a highly competitive, lower rate.
Yes, but here is the critical distinction. Because the traditional bank's offer is so uncompetitive, Upstart doesn't have to price their loan at rock bottom to win your business.
They just have to beat the bank.
Precisely. Because their AI is vastly superior at pricing risk, the gap between Upstart's precise rate and the bank's blunt rate is massive. That widening gap gives Upstart incredible long-term pricing power. They can actually capture a slightly higher take rate on their end while still giving you, the consumer, a significantly better deal than the legacy bank.
That is a brilliant dynamic. The AI doesn't just lower risk, it creates a pricing mode. So when they say a product never truly matures, they mean the AI is constantly finding new micro-efficiencies to widen that gap against legacy competitors,
Exactly.
allowing them to continuously optimize and squeeze margins over a 7, 8, or even 10-year horizon.
It completely redefines competitive advantage. It's not a static feature you build once, it's a compounding engine of efficiency.
Which makes me wonder what this compounding engine looks like when applied to the absolute opposite end of their product spectrum. We just spent time analyzing massive home equity lines of credit and massive auto loans.
The big ticket items.
Right. But during the call, they fielded questions about a fascinating microcredit experiment called Cashline. How do you apply this highly complex AI to a product that small? Isn't underwriting microcredit a completely different beast than analyzing a $10,000 personal loan?
Oh, it is an entirely different operational beast, but the underlying AI capability is the only reason it's possible. If we connect this to the bigger picture, Upstart is clearly trying to build an inescapable credit ecosystem for every single stage of a consumer's financial life.
Wow.
The Cashline product is specifically targeted at users who need very small amounts of liquidity. We are talking a couple $100s, not thousands, but they need it very frequently. Think multiple times a month or a quarter to bridge the gap between paychecks.
Well, to underwrite a $200 loan that the user is going to pay back in 10 days and then borrow again next week, that requires a completely different mechanism. You can't put someone through a 3-day underwriting process, pull their credit manually, and pay human analysts to review documents for a $200 transaction.
No, absolutely not.
The operational friction would cost more than the interest you'd collect.
Exactly. It requires instant, frictionless decision-making. The AI has to approve the loan in milliseconds based on real-time cash flow data without burning operational capital. Management stressed that while the individual dollar amounts are tiny, the lifetime value of these customers is massive.
Because they come back.
Right. A returning customer who reliably uses a microcredit line, pays it back, and trusts the Upstart ecosystem is incredibly valuable. It introduces them to the platform, and when they eventually need an auto loan or a personal loan, Upstart is already their financial hub.
But doesn't funding thousands of rapid-fire tiny loans create an absolute nightmare for their balance sheet? You have hundreds of thousands of microtransactions flowing in and out daily.
This raises an important question about the velocity of capital. Right now, it is not a balance sheet concern because the loans are so small and the duration is so incredibly short, meaning they are paid back in a matter of days or weeks. They don't tie up a significant amount of actual capital.
The money goes out and it comes right back.
Exactly. Management explicitly stated that Cashline is practically invisible on the balance sheet currently. However, as the product scales, they aren't going to fund it themselves forever. They will eventually secure dedicated third-party funding partners whose infrastructure is specifically tailored for that high-velocity, fast turnaround profile.
It's incredible to step back and look at the sheer scope of the transition we've decoded today. Upstart is fundamentally restructuring the invisible pipes we talked about at the top of the show.
They really are.
They are pursuing a national bank charter. Not to play the traditional banking game of taking your deposits, but to cut out the massive friction of middleman sponsor banks, bypass fragmented state laws, and patch a $200 million hole in their structural efficiency.
And they're doing it while fiercely guarding their capital with high internal hurdle rates.
Exactly. And they are expanding across the entire spectrum of consumer needs, from huge, secured home equity loans that shift their take rate dynamics all the way down to instant AI-driven $100 microcredits with Cashline.
And weaving through every single one of those strategic moves is the relentless reality of their AI models. They are letting the algorithm continuously widen the gap against traditional banks, fundamentally rejecting the idea that a financial product ever reaches a static point of maturity. For you listening today, whether you are trying to value a tech stock, building out your own company's infrastructure, or simply trying to understand how your own personal finances are going to be managed in the next decade, the core lesson here is profound.
Yeah.
AI in finance isn't just about faster processing speeds or deploying a slightly better customer service chatbot. It is about fundamentally restructuring the unit economics of an entire industry from the absolute ground up.
Tearing out the foundation while the house is still standing. Which leaves me with a thought I can't quite shake after looking at how deeply this AI analyzes human behavior to widen that pricing gap.
Hmm.
If an AI lending model never truly matures because it is continuously ingesting data from every single transaction to perfectly price our future behavior,
Yeah.
at what point does the algorithm actually understand our financial habits, our hidden risks, and our economic futures better than we do ourselves? When the invisible plumbing gets that smart, who is really directing the flow of the water?
That is the multi-billion-dollar question, and one the regulators are going to have to figure out very quickly.
Something to mull over as you navigate your own financial choices today. Thank you so much for joining us on this deep dive. Keep looking beneath the surface, keep asking the hard questions, and we will catch you next time.